very good evening. Very good evening, everyone. Welcome to this exclusive webinar session we are conducting. We are already organizing such kind of webinars for the last 1 year or so, calling industry experts from various AMCs, fund managers, CIOs, and CEOs who share the thoughts with us on the various parameters on the investment side. We have invited a lot of people in equity. We have invited a lot of people who shared their thoughts on the gold as an investment and international equity. So we thought that yes, fixed income is something which is quite exciting these days, and people are quite excited to see the increasing interest rate scenario globally. So as to understand what exactly fixed income is doing in terms of investors' portfolio and what the investors should do, and how the Indian and global market look like in terms of rate revisions. So we thought it could not be better than Mr. Devang Shah, who is the co-head of fixed income at Axis AMC, and his core responsibility includes managing top quartile performance for all funds and managing client relationships. And he has joined Axis AMC on October 2012 as fund manager and promoted to co-head in May 2021. He has been actively involved in ideation, sourcing, and investment strategy for fixed income funds, which makes him a very right person to share his thoughts on the fixed income industry in the current scenario. Before this, he was working with ICICI Pru MC as a fund manager from April 2008 till October 2012 and ICICI Prudential AMC. His role was to manage funds and was head of credit for the fund house. He was also worked with Deutsche AMC and PwC in the past. Qualifications BCom and gold medalist in financial management, associate member of ICI. And without taking much time, I would like to invite Mr. Devangsha to share his broader thoughts on the fixed income at a macro and micro level. And after that, we will have a Q&A session where we have already got a couple of questions from our viewers and participants. We will try to get answers from our esteemed speaker. And then we are quite okay to have any more questions. If you have, you can put it in the chat window and then we can address it one by one in the interest of time. Without wasting time, I will just invite Mr. Devangsha. Welcome to you, and please share our viewers our thoughts that yes, what fixed income look like, what exactly they need to do, and what are the things they need to keep in mind while considering fixed income as a part of the investment portfolio.
Thank you, Mohit, and thank you, everyone. A very good evening to all of you. Yes, I think last 12, 18 months, fixed income has been the space which has been quite volatile. And a lot of interest has got generated specifically in the last 3, 4 months, where markets started to believe that we are now reaching the peak of the interest rate cycle. Obviously, last 12 months, and specifically on account of significant increase in rates, significant impact on account of what is happening globally, I think markets has been in a big chaos. To start with, I think if you actually look across just 12 months back is where entire global central banks and everywhere, including RBI, started to look at talking about interest rate hikes. And why that happened? February 2022, we had an event where the Ukraine-Russia crisis came as a surprise. Obviously, significant impact on supply side, oil, commodities, supply-led inflation led to panic among central banks. And please remember that central banks across the world were actually in an accommodative, easy liquidity, and significant rate easing cycle because we were just coming out of COVID. So it was a very, very difficult scenario for central banks to maneuver from a environment where we are just planning to see beginning of the growth cycle, probably end of COVID. And at that point of time, this entire surprise on account of the Ukraine Russia crisis shook the central banks. What was the central bank reaction? I think very obvious. First, to withdraw liquidity because liquidity was significantly ample and it can be very, very inflationary in such kind of environment. And secondly, start increasing rates. The rate hikes were significantly at a higher quantum and at much more faster pace. So I think in the history of last 15, 20 years, we have never witnessed Fed moving from discount to 500 basis, that is 5%, 5 to 5 quarter band now, with in a span of less than 6 to 9 months. So the Fed hikes happened very, very fast. If you look across at RBI also, RBI moved from 335 on
Hmm.
April 2022 to currently in the last policy, just before the last policy in February, they had taken the repo rate to 6.5. So a 315 odd basis increase. Hello, am I audible?
Yeah, Devang, you are quite audible.
Yeah, sorry. So 315 odd basis increase in the repo rate. So
Hmm.
what we have been seeing is that significant increase in rates have already happened. And now, if I look across at the impact, one, the growth has started to show slowdown significantly. Secondly, we have also started seeing the peak of inflation.
Hmm.
Thirdly, commodities and the supply led chain inflation have started to ease up. So the Ukraine Russia crisis, which was going on, has come probably, even if it is not ended, the overall supply led inflation has come to an ease.
Yeah.
Oil prices have significantly fallen. We have
Hmm.
seen massive correction in specifically oil. So oil had moved
Hmm.
to from hello.
Yeah.
Yeah, sorry, oil had moved from 90 odd dollars to 130 $135. They are now back to below 70. So the
Hmm.
thought process for us is that we are actually reaching the peak of the interest rate cycle. Secondly, growth has started to come off. And thirdly, we have also started to hear accidents happening specifically in the global banking side. If you look
Hmm.
across at first, we saw an SVB, and then somewhere down the line, you had Credit Suisse, you had other banks looking significantly weaker, and First
Hmm.
Republic, and their name goes on. So
Yeah.
the overall impact what we have started to see is, one, I think growth has started to significantly muddle down. Secondly, we have now see the peak of the interest rate cycle. And third, financial conditions have got significantly tighter. What we
Hmm.
believe now is that probably Fed will look at a pause incrementally from here on. RBI has already done a bold step of pausing before Fed, but we believe that RBI will continue to be on a pause mode for at least 2 to 3 policies, and we don't anticipate any immediate rate cuts. The important element from the monetary policy, which all of us should gather across, is one, RBI is still very bullish on the growth cycle in India, and we believe that growth, RBI's projections are at 6.5%. Our projections are around 5.5. We believe that a rub-on effect on a global slowdown.
Hmm.
Secondly, from next year onwards, we start seeing fiscal consolidation. Thirdly, I think this entire impact of consumption cycle, which was very, very bullish, with
Hmm.
liquidity significantly getting tighter, inflation being on the higher side for last 2 years, I think we start seeing some bit of impact on consumption cycle also. So our thought process is that I think RBI is very, very bullish on the growth.
Hmm.
Secondly, on inflation trend, RBI is projected an inflation of 5.2%. We believe RBI is very idealistic in anticipating an entire year average inflation of close to 5.2. We believe we also, our projections are also similar, and we believe that inflation will be in the 10 range of 5 to 5.25. So
Hmm.
lower inflation, lower than anticipated growth, I think will keep RBI in a pause mode and dovish. And once we start seeing the Fed to pivot, and what do I mean by pivot is Fed's cutting rates, I think our markets will start pricing in rate cuts. So this, even though we might see rate cuts getting delayed because we are
Hmm.
not anticipating a growth shock in India like we're anticipating globally, but definitely we will start seeing rate cuts getting priced in. And that is where the second leg of rally would come. In the
So
last one
Devang,
month,
can we? Yeah.
because of
Sorry.
a Fed pause, a Fed last hike, RBI pause, and thirdly, significant. Yeah,
Yeah. So I think, as you rightly said, that while we saw RBI putting a pause to
yeah,
rate
yeah. Go
hike
ahead,
in
Mohit.
last meeting, and repo rate stands at 6.5%. US Fed has increased by 25 bips to 5.25, and ECB maintained rates at 3.75. We also saw Australian bank increasing rate to 3.85. So I believe the views which you have shared from the global rate point of view, that yes, inflation is already at peak, and from the growth standpoint also, there can be a pause in the further rate interest hike. So overall, what do you suggest from the customer point of view as a global rate outlook going forward?
So our view is that we have actually seen the peak of the interest rate cycle everywhere.
Hmm.
We believe that now, including US Fed, RBI, and most of the other central banks, I think incremental rate hikes look limited. What
Hmm.
we are of the thought process is that probably in this year we would not see massive rate cuts because
Hmm.
central banks would want to err on the side of caution. They've already been wrong on inflation projections for long. Okay, at least
Hmm.
when it comes to US Fed, they were expecting first some bit of slowdown.
Yeah.
There's significantly easing of inflation, but inflation went all over, and we have 15 months of US CPI higher than India CPI. I think this has never happened in the
Hmm.
history of last 20-25 years. So as per us, what we believe so is that somewhere down the line, I think we have reached the peak of the interest rate cycle. From here, we will start seeing a downward interest rate
Hmm.
because central banks would want to err on the side of caution. They would not be very fast unless and until we see accidents like had happened in March and mid of April, where some banks collapse, regional banks on in the US
Yes.
economy collapse. If we don't see any further collapse, we believe that September to December 2023 is where Fed will start delivering rate cuts, and post that RBI will also start delivering rate cuts.
Okay. And since Indian bonds are also already rallying, are they pricing in decline in inflation now since edible oil rates, oil prices down and crude is down?
So our understanding is that definitely we are expecting. I don't think so. It will be wrong on our part to probably say that there is zero rate cuts now priced in. I think the swap
Hmm.
curves are now started to price in at least 50 basis of rate cuts
Hmm.
or slightly more. The funded curve, which is bond market, government bonds, the short end of the curve, is pricing in at least, I would say, not more than 25 basis cut. So our view
Okay.
is at this point of time, we believe that immediately, with once the Fed pivots, our markets will also start pricing in rate cuts, and we anticipate at least a 25 to 50 basis of rate cut till March 2024.
Oh. And what happens if US Fed increase rates? Will it be a given that RBI will also increase rates from here and our inflation data points have already hit a comfort zone and we might not see rate hike here?
So my understanding is, see, even if US increases rates, I
Mm-hmm.
don't personally. First of all, I would say a small probability that US increase rates now. Already, financial conditions have got massively tighter. If you actually
Hmm.
look at incrementally data from there, we have seen lot of data, which is all the lead indicators. Okay, there are some
Mm-hmm.
factors which are more, which gives you what has happened, but it is all more pertain to the past economic data, and there are some trends, data points which give you an outlook on what is going to happen in future. The lead indicator, those are called lead indicators. The lead indicators have already started showing massive slowdown. So for me, I think it is a very difficult call for Fed to hike massively. But supposedly, if inflation goes out of whack and Fed still hikes, I believe that RBI would continue to be on a pause because our inflation trajectory for Q1 and Q2,
Hmm.
which is up to September, is all showing around sub 5% inflation. We're already at 6.5 on the repo rate. 125, 150 basis of real positive rate. I don't believe that even if we see a 25 basis hike from Fed, RBI will hike further. RBI will be on a pause mode only. Yes, for cutting rates, I think unless and until we see a growth shock in India and our probability is lower, I would say. And what I mean by growth shock is sub 5% GDP number. If we
Mm-hmm.
start seeing it too fast, then probably RBI might be cutting rates ahead of Fed. Otherwise, RBI would start cutting once the Fed pivots.
Okay, certainly. In fact, Devang, I have seen that yes, now Indian industry or any industry is a cyclical business. So, in fact, for that also we can say it has completed almost a full cycle, right? So, what is your view on 10-year, 1 year, or medium term government bonds as a strategy? Will you like to look more at a long tenure now, or it should be medium or short term? What exactly you believe it should be?
So I think two perspectives. From a fund strategy perspective, obviously at this point of time, it makes sense to buy long bonds because I think till the what we have traditionally seen is long bonds starts pricing in cuts first, okay,
Hmm.
and the short bonds rally only after the rate cuts get delivered. That is not only in
Mm.
India, that is across the globe. That is how fixed
Yeah.
income markets work.
Yeah.
So, as today, when we are talking about still when the rate cuts will happen, how much will be the rate cuts happening
Mm.
through in this cycle, I think at this point of time, to capture the interest rate cycle as well as the rally on account of rates, I think across all our funds, we would be advising or we would be adding exposure to duration assets. When it
Okay.
comes, when once the first rate cut gets delivered, it is actually after that the pace, the overall quantum, which is important. And our belief is, in this cycle we will not see massive rate cuts. Please
Mm.
understand, we are not like Fed, where we have moved from 0 to 5.5. Okay, we have moved from 3.5 to 6.5. Secondly, in India, I think inflation to go massively below 4% looks difficult. In fact,
Yeah.
4.5, 5% is somewhere we have not seen below 5% inflation. If I look across at the average trajectory for last 5 years also, and where
Mm.
a lot of supply side led inflation measures have been under control. So our view is that below 5% inflation in India to on a sustained basis looks difficult. So with 100 basis or 125 basis of real rate, we don't anticipate RBI to go in this cycle below 6%. So at the 50 basis of rate cut, RBI will be slow and gradual in cutting rates. And hence our view is, to capture this rally first, we should buy long assets, and then probably once the rate cut cycle begins, we should
Mm.
start buying shorter dated assets or short to medium term funds.
So
From a
can
category, sorry, yes.
yeah, yeah, Devan, please go ahead, please. Sorry.
No, so what I was trying to say is that for investors, okay,
Hmm.
it is actually, there are three set of investors which we have traditionally seen in fixed income markets.
Yeah.
One who is more conservative and who wants to be a, I would say, a permanent fixed income allocator, okay, and who is
Hmm.
trying to target those FD kind of returns from investor with view of riding the interest rate cycle, somewhere very very safe products, quality bias, AAA oriented funds. Okay, that's the
Hmm.
strategy which we have seen. There's one set of investors. I think we are advising short term funds for those set of investors. This is despite the change in tax guidelines, despite everything. I think once you are a kind of an investor who is very conservative and who is always looking for quality, I think short term funds makes a lot of sense. When I mean conservative, they do ride the interest rate cycle, but they don't see massive volatility in an interest
Hmm.
rate hike, and vice versa. They will not give huge gains in an interest rate cut cycle also. But these products will definitely outperform other alternative fixed income solutions. The second category of investors, what we have seen, is a category where who is always targeting that 50 basis additional over a FD. His
Hmm.
mindset is that I would want to invest in a corporate FD kind of a, solution. And for
Hmm.
such category investors, we're advising medium term funds. Okay, the medium term category makes a lot of sense. Generally, in these category, there is a 3 to 4 year duration bucket. You have 50-50 mix of AAA, AA assets. So good to hold, diversified portfolio, generally good for investors who are targeting corporate FD kind of return. And the
Okay.
last category, the third category, is the category who wants to give the fund house full flexibility, the fund manager full flexibility, and he relies on the fund manager to play the interest rate cycle as and
Hmm.
when. So go long, capture the interest rate cycle tactically, and probably then go short and run the fund as an ultra short term fund or a short term fund, okay, depending on
Hmm.
interest rate view. For such investors, I think dynamic bond fund or all seasons bond funds, dynamic bond fund category, which are now
Hmm.
some fund houses have renamed it as all seasons bond fund category. I think
Hmm.
these two category makes a lot of sense for investors. So these are the three set of solutions depending on the type of investor.
Beautifully said, Devang. I think the audience was also have an interest to understand what kind of investor they are. There are people who are always look for fixed deposit kind of return with certain security and safety and liquidity. There are people who consider fixed income as one of the objective to invest for additional alpha over the benchmark. And of course, there are a third type of investor who want to take some kind of risk, defined risk, basis the expertise of the fund manager. And there are particular categories which can cater to needs of all these three type of investors. So I think this reply answers most of the queries which our viewers have. When you said corporate bond funds with a mix of AAA and AA, what is your preference on tenure and quality at present? there is no shortage of liquidity and innovation at present in issues and mode of issues?
So, a very good question, Mohit, actually, because it is important that in such kind of environment where there's so much of volatility, does it have an impact on our credit cycle?
Hmm.
Our belief is that last 2 3 years, first of all, corporate balance sheets have got massively repaired. Okay, leverage, if you look across at solvency, liquidity, I think we have had the best of the times on the credit cycle. Secondly, there
Yeah.
was a lot of push from RBI. Liquidity was significantly ample. Thirdly, there was this emergency credit guarantee schemes which was run by government. So all
Hmm.
kind of support from government, RBI, significant demand-led push drivers have all led to good positive credit cycle. As per me, I think the credit cycle continues to remain strong and positive for the near term. I think for the next 12 18 months, we are still neutral to positive on the credit cycle. Post that, we'll have to see how this entire cycle pans out. If we see massive slowdown, then I think we will start seeing some bit of pressure on corporate bond spreads and some possibility of accidents or the credit cycle to worsen. But at this point of time, I would say for the next 12 18 months, we are neutral to positive on credit. What we are doing, hence, in our funds, which wherein we have AA mandates and we can take credit exposure, we are
Hmm.
allocating to AA and single A assets at a spread of around 100 odd basis for AA and 200 to 250 basis for single A over triple A. So that's the
Oh.
thought process. And we generally are under no compulsion to buy credit. What we believe so
Hmm.
is today we link the credit cycle to the economy. And because India is an economy which is still holding strong, the near term credit drivers are strong, the valuation is okay, and hence we
Hmm.
are allocating to AA. But once we are done with, I think probably in the next 12 18 months, when credit cycle starts looking weaker, we'll shift the AA allocation to AAA.
Okay. So if we talk about the mix of double A, triple A, and single A as of now, so what would be the ideal mix in the corporate bond funds going in the market in this current strategy right now?
So, see, there are three strategies. As I told you, for me, the first strategy, which is very conservative clients, we
Hmm.
generally hold their 100% AAA kind of a portfolio. Okay.
Okay.
The second set of investors, which is there, who's targeting the corporate FD and which you have been talking
Hmm.
about, the general mix there is around 50-50. Around
Okay.
50 to 60% is in AAA assets, around 30 to 40% is in AA, and around 10% is in single A assets. That's the composition of those funds. And the last
Hmm.
category, which is dynamic, which is pure interest rate call, and who investors who want to play the interest rate cycle tactically. There,
Hmm.
the entire the quality as of this point of time is more run through GSEC and long corporate bonds.
Great. Great. So I think, Devang, I would like to say to my viewers that it is not no more a traditional product, right? Which fixed income used to be. Now, fixed income also comes with a variety of bouquet of sub products, which caters to the needs of all the investors, depending their risk profile and depending their own requirements and tenures. So, fixed income portfolios also offer multiple kind of categories in within, so that can cater to all kind of needs of different customers. Great, great. Since you have mentioned credit metrics driven decisions by the fund managers for the funds in current scenario and fixed income, is there any specific sector for corporate bonds which you are looking for, or any preferences for the sectors?
See, in fixed income, I think a large portion of issuances happen in the financial sector. It's like the public sector
Okay.
undertakings, public financial
Hmm.
institutions, banks, and NBFCs.
Hmm.
So I would say, if I pick up any fixed income product in India, I think 40-50% allocation will be to PSU, PFIs, NBFCs, and banks. Okay, the
Hmm.
balance sectors, when we look across it, I think we are positive at this point of time on cement. We are picking up autos, auto anchs. So all these sectors are reasonably doing good. Their leverage has significantly fallen. What we are at this point of time being watchful on is probably commodities, because commodities is going through its own. We have had a beautiful cycle in commodities for last 2 3 years. Okay,
Hmm.
China is slowing down, global growth is slowing down, so we would be slightly, I would say, wait and watch on commodities. Except for that, if you ask me at this point of time, even the real estate, if you look across at the demand and you look across at the residential demand, I think it's been
Yeah.
doing very strong. So
True. True.
for the near term, I don't see concerns on any of the sectors. And in India, fixed income products, if you actually look across it, is largely financial sector, PSU, PFI driven, which is public sector undertakings and public financial institutions. Mohit, you
Hmm.
made a good point, and I would just like 2 minutes to cover that. I
Sure.
think SEBI has done a beautiful job of categorizing funds. Okay, and as you rightly pointed out, if we need two things, which is very very important from a fixed income investor, and if we know that, I think the experience of the fixed income investor in or his journey in investing will be very very positive. The first aspect is his investor horizon. What period he
Mm.
wants to invest into. If it is one day, we have a product from 1 day to 30 years. If you want a
Yeah.
1 day, you have an overnight fund. If you have a 90-day product, you have a liquid fund. If you have a 10-year product, you have a 10-year constant maturity or a GSEC fund. Or if you have a 30-year product, we have a 30-year product also. The important element is to find out his investment horizon. And second is risk appetite, whether he is wary of credit or not, or the volatility on interest rate cycle. What is his risk
Mm.
appetite? If he is cautious, I explained to you the short term category. And if he is
Yeah.
a kind of an investor who is tactical and who understands interest rates and credit risk, I think dynamic bond funds or all seasons bond fund make a lot of sense. So I think these two
Mm.
parameters are very, very important to judge when we are
Mm.
actually analyzing investors. And SEBI has done this grading of categories beautifully for investors so there is no confusion and overlap.
Certainly, certainly. In fact, I myself, as an investor who has a maximum exposure to equity, these days I am also excited considering the uh, completion of cycle of debt. I myself is interested to park some funds in the debt category per se. In the last couple of weeks, we have seen a lot of corporates have released their earning results for the fourth quarter. What is your view on the same? How you see it?
So I think the margins have massively improved, and it's on
Mm.
account of significant reduction in costs. So
Mm.
raw material prices, which had got massively inflated on account of supply chain issues, okay,
Mm.
that we have started seeing significant betterment. Secondly, we have also seeing a lot of push on for some working capital requirements. Capex have
Mm.
started for certain sectors. So if you
Mm.
ask me on an overall perspective, and demand volume growth have continued to remain, like the last year has been very very strong on demand, and we have still
Mm.
seen some bit of demand continuation, except for, I would say, FMCG and consumer staples. I think and consumer durables is
Mm.
where we have started seeing some bit of demand cooling. If you still ask me, lot of real estate push, lot of residential demand, lot of infra demand, lot
Mm.
of and IT sector. Except for these two
Yeah.
sectors, I think overall we have seen all positive sectors, and specifically on account of reduction in raw material prices, and
Mm.
secondly continued demand, people have been able to deliver good results.
Great, great. Now comes the elephant in the room, strategy for investing in debt funds for the recent finance bill on taxation. So everyone was quite excited when the budget announced different taxation for the debt, different for hybrid and equity. So how you see the impact of taxation on the debt, and plus what should be the strategy for a investor while considering debt to be part of their investment portfolio? If you can share some thoughts on it.
So see, as I told you, I think the first important characteristics or general myth is that equity is all about value creation and debt is more about safety. I think if
Mm.
I look across at longer term returns, and I'm talking about 25, 30, 35 years, okay,
Mm.
fixed income and equity returns, the gaps are not huge. It is because
Mm.
equity gives returns in 1 2 years. Okay, there are periods where they give 30, 40, 50% returns, and
Mm.
then they probably give a flat kind of a return over the next 2 3 5 years. In fixed income, the power of compounding and an annual accrual of 7 to 8% matches up the returns over a longer term period. So the point we're
Mm.
trying to put across is, first, depending on your age, depending on your risk appetite, you should have a fixed income allocation. Now, coming to the specific question on post the changes in taxation guidelines, how are we looking at fixed income funds, and probably what should investor do?
Yeah.
Two three things. First, always this question comes about that why not then directly go to fixed income solutions like FDs, corporate FDs, and why invest in FD, mutual funds?
Mm.
The important element is liquidity, diversification. Okay, when you're investing in one FD, okay, you are just taking one specific corporate exposure. In a mutual
Mm.
fund, if you look across at the portfolio, it is very very significantly granular, diversified into top 20, 30, 40 securities. So
Mm.
first is significant diversification. Second thing is the liquidity. Okay, like T+1, when you go and break the FD, you will have to be paying a significantly lower rate. You will be
Yeah.
charged with a penalty and XYZ. When it comes across to most of the fixed income funds, they don't have exit load also. The liquidity is
Mm.
T+1, easily available. So the ease
Mm.
of flexibility and mode of the entire dealing is significantly easy. The third important element is deferment of tax. In a fixed deposit solution, you still get interest payout every year. You have to pay tax on that. If not,
Hmm.
they will cut the tax and give you the interest. In fixed income, where the year which you want, if you have a loss XYZ, you can set it off against the gain. So whenever you want, the deferment of tax incidents is at your choice. So these, I would say, these are three important flexibilities which a mutual fund allows as compared to a FD or another kind of solution. If you ask me personally, another important element today, if you said Mohit, and I think this now it's a common, I would say, inference which a lot of
Hmm.
fund managers, MFDs, and people advisors, financial advisors are giving,
Hmm.
that we have actually reached the
Hmm.
peak of the interest rate cycle.
Yeah.
You, except for mutual funds, if someone wants to actually ride this interest rate cycle, there is no other product which offers this opportunity. So if someone actually wants to pick up and ride the macro cycle on fixed income funds and fixed income
Hmm.
rates, I think it is only through the mutual fund channel. Coming
True.
to what categories of fund should an investor invest into? I think my answer remains the same. If he is a tactical investor who is
Hmm.
coming to ride the interest rate cycle, make some capital gains on account of rate cuts, and then probably exit, or
Hmm.
wants to have the fund manager to manage the fund in a way when you are at the peak of the interest rate cycle, increase the duration, and vice versa, when you're at the bottom of the interest rate cycle, run it like an ultra short term fund. I think
Hmm.
the dynamic bond fund category makes a lot of sense for such investors
Okay.
despite the taxation guidelines. And we have seen time and again, if I look at dynamic bond fund category, and I'm talking about now composite bond fund index, which is a
Yeah.
index for dynamic bond fund, I'm not talking about specific fund, or a
Hmm.
short term bond index. Over the last 15-20 years, we have seen that these categories over a 3-year rolling return deliver 50 to 75 basis over FDs. So if they are delivering 50 to 75 basis higher return, and this is all I'm talking about pre-tax, okay? So
Hmm.
before we used to get the tax benefit also, but right now
Yeah.
also these funds on an overall perspective, except for 2008-9 global financial crisis, 13-14, which is the overall the financial crisis on account of tapering, and a part of 2018-19, we have
Hmm.
seen dynamic and short-term bond funds 3-year rolling returns delivering at least 50 to 75 basis over FD and other fixed income solutions.
Wow.
So our advice is that for riding the interest rate cycle, today, if you want to pick up, I think the easiest solution is a dynamic bond fund or an all seasons bond fund. And for conservative investors, it is a medium term or short term fund category.
Certainly, certainly. No, I think that is a very interesting view because a lot of people had queries, and I also countered so many people in terms of giving them clarity that how the taxation works for debt and how it doesn't make any impact to your existing portfolio. And if you're a smart investor, you enter into the debt at the right time. So, no, of course, it will give you. Considering the right category and the tenure they have chosen, it definitely come to a better decision making in terms of own portfolio.
Right.
Few people always have queries regarding the FMPs. If you want to throw some light, whether they should consider FMPs over fixed deposit or traditional products, and how FMP can be part of their portfolio, whether it is wise to do that or no. So,
Okay. So my understanding is, see, with this guideline changes, okay, FMPs were traditionally used as a tax efficient solution. Okay,
hmm,
these were, and first of all, as against FMPs, now mutual funds have come up with an open-ended FMP in the form of an index category. So these are
yeah,
the so-called popularly called target maturity funds.
hmm,
Low cost, you know the portfolio. In FMP, you never used to know the portfolio. Here you are, we are giving the index, we are going to replica the index. It is low fee expenses product. So I think
hmm,
incrementally, the overall thought process on FMPs has significantly mellowed down. People have started choosing open-ended index funds or target maturity funds. But personally, if you ask me, if you want to ride the interest
hmm,
rate cycle, and if you are a fixed income investor, and now the days come for alpha generation. Okay, previously what we
hmm,
were trying to put across is the thought process of fixed income funds, and I have a thesis for this. Okay, it's like what happened is pre ILFS and DHFL and all these issues. I think investors started losing confidence on mutual
yes,
funds, and hence there were a lot of Me Too products
hmm,
which were designed for meeting investor needs. Okay, that target maturity fund is a kind of a solution which actually is like an open-ended FMP. Okay, you come across, you replica the
hmm,
portfolio, and there is no fund manager active participation in that or alpha generation in that. It is just replication of the index, and they will deliver you the index returns, which are already any which is when you're entering the fund, you know what YTM into you are
Yes.
entering into, and you'll get somewhat similar kind of
Yeah.
returns. When it comes to now in this entire change environment where taxation guidelines have changed and everything, I think it is now we have gone back to 2000, pre 2018, 2010, 2010 to 2015 era, where it was all about active
Mhm.
management, generating that alpha for fixed income investors, and that is what will now start playing important in fixed income allocations. As per me, dynamic bond fund, short term bond fund, and medium term categories over a sustained basis, looking at investor appetite, looking at investor risk appetite, as well as investor horizon, these are the products which makes lot of sense for investor on an ongoing basis. So investors who want to ride interest rate cycle, who want to generate that additional returns, and who are actually I would say long term investors in fixed income schemes, I think
Mm.
these three categories makes lot of sense.
Okay. And I believe from the AMC, Axis AMC, which is one of the top AMCs in India, you have all the offerings with you where customers can choose the category as per their own choice.
Yeah, so our fact sheet
Correct.
or our website would have all the details of all the three categories and the fund in these categories. So dynamic bond fund, we have a fund. For medium term, we have a fund Axis strategic bond fund, and for short term
Right.
category, we have a fund which is Axis short term fund. So we have a
Okay.
category, fund
Good.
category in all of these categories, and not only Axis, I think a large part of all top five, top seven
Yes.
AMCs would have
Yeah.
funds in these categories.
So, in fact, from the traditional way of investing in fixed income, people, it's for the viewers, I would say it's the right time to explore more categories from the insights which have been shared by Devang and beautifully said. In fact, I got some doubts cleared from the conversation I have. And I believe myself that I will be able to take a better investment decision for my own portfolio in the current cycle to take maximum benefit out of it. Thank you so much, Devang. I can't see more questions, and it was a wonderful session where you have covered macro and micro level of market outlook about the fixed income. And our viewers and our team members always have some concerns that yes, what to do in this current scenario, what will happen if the interest rate increase or it will go decline, whether US will increase the rates, what will be the impact on the RBI, and all these questions which you have answered beautifully. I believe that will definitely help our team members as well as the viewers who are users and customers to make some wise investment decisions. Thank you so much, Devang and Axis AMC. Thank you so much, viewers. And you always have opportunity to explore Bajaj Finserv platform as well, where you can get details of all categories of mutual fund so that you can explore and you can make your investment decision better. Thank you so much, and thank you all the stakeholders who have made this webinar successful and possible. We will again come back with some kind of interesting education awareness program where people from various AMCs like Devang will share their thoughts and will try to get answers for all the questions you guys have. Thank you so much, everyone. All the best. Thank you.
Thank you.